It's 1988, and you have a $100 bill, and you're pretty smart, so you decided to invest your money. And let's say you have three options. Option 1, bury your $100 bill in your backyard. Or option 2, give your money to the greatest investor of all time, Mr. Warren Buffett. Or option 3, give your money to a mathematician who told you that he will invest your money using computers. Remember, it's 1988. You know how the computers were, right? So, who will you choose? Obviously, the greatest investor of all time, Mr. Warren Buffett. There is no question to that. But is he the greatest investor of all time? Let's see. So, let's compare what your money would have grown to in 30 years' time period.
Now that's a little too much.
So, if you buried your $100 bill in your backyard, then it would still be $100 bill. What were you expecting, huh? If you know even a little bit about inflation, then you probably know that it's not an investment. It's like creating a relic from the past. Anyways, if you had invested that money with Warren Buffett, then your $100 bill would get converted to $22,578, assuming 19.8% compound growth rate annually, which is the average return of his firm, Berkshire Hathaway. Damn, that's impressive. This is the power of compounding, and thanks to Mr. Warren Buffett, you are rich now. You can also think about retirement, right?
Well, actually, let me just say something. I'm quitting.
Obviously not, but you are happy now that your investment paid off, and you wouldn't regret your decision until I tell you this, that if you had invested in the third option, your $100 bill would have been converted to nearly $400 million. Yes, that's nearly $500 million. I know you must be thinking how it's even possible. That's absurd, but...
You serious?
It's true indeed. And a person named Jim Simons did it with his famous fund, the Medallion Fund.
So I think I found Wall Street's biggest secret. It's called the Medallion Fund, and it did something that shouldn't even be considered possible. It cracked the secret code of the stock market.
Yes, Jim Simons, a man who was the highest paid hedge fund manager, who made $1.5 billion in 2005, $1.7 billion in 2006, $2.8 billion in 2007, should I keep going? His net worth was around $30 billion, and he didn't wear socks. That's important because who knows? He gave away $500 million to his college. Sorry, to his wife's college. Also, he even has an asteroid named after him. Asteroid 6618, Jim Simons. And you know what? He didn't even discover it. It was discovered by Clyde Tombaugh in 1936. I feel sad for the scientist who discovered it. I don't know how this information was relevant, but you never know, right? So, in this video, we will discuss the trading strategies used by Jim Simons in details and understand the secrets that made him a billionaire. But before that, we need to understand something very important. There is a very famous theory in finance. It's called the efficient market hypothesis. It basically says that the price of an asset reflects all the publicly available information. Hence, the current price of an asset is just perfect. Yeah, basically it means that you cannot make money while trading stocks. I also used to believe this.
Wait, what?
Well, not exactly this. I thought short-term stock price movements were mostly random, and that day trading was a losing game, and it's equivalent to gambling. I never liked internet gurus teaching technical patterns, predicting price swings based on some graph line. I admired legends like Warren Buffett, Ray Dalio, Jordan Belfort.
Was all this legal?
Well, maybe not Jordan Belfort entirely, but mostly those who focus on fundamental analysis, which means evaluating a company's earnings, growth potential, and so on. But, when I heard about this man, Jim Simons, all my beliefs were shattered. I remember how I once had a fight with my friend over this topic, that trading in short term is gambling, and I was so determined that I was right, but now I understand I was wrong. Even Mr. Warren Buffett said this.
But they were very, very smart.
Yes, they got very rich.
Very, very smart.
And very smart and very rich, yeah. And very high grade, by the way.
Yeah.
Jim Simons.
Basically, Jim Simons said fuck you to efficient market hypothesis and made billions of dollars, just like Jordan Belfort, but legally, of course. Well, efficient market hypothesis is not exactly wrong. We will see that in this video. But before that, who the fuck is this guy? Jim Simons? James Harris Simons, or Jim Simons, was born in Cambridge, Massachusetts in 1938, exactly after the Great Depression and right before the World War. He was an intelligent kid from the start, and like all intelligent kids, He was interested in mathematics. He got into MIT for his bachelor's in maths, and he even skipped the first year because he had already taken those classes when he was in high school. After graduating from MIT, he went from Boston to Bogota, Colombia on a motor scooter. Damn, that must have been fun. So, he wasn't a total nerd after all. After that, at the age of 23, he completed his PhD in mathematics from UC Berkeley. Remember, PhD at the age of 23.
Is that bad poetry, or is it supposed to mean something?
Also, till now he is still not involved in any sort of trading. He just loved maths and was going to pursue it as a career. So, just after his PhD, he started teaching at MIT and Harvard, along with pursuing his research work on geometry. He did a lot of contribution to maths like Chern-Simons theory, which was later used in physics, and also contributed to the development of string theory by providing a theoretical framework to combine geometry and topology with quantum field theory. Damn, guys. He really was intelligent. But there's something more interesting he did. He worked for the NSA, specifically for IDA, or Institute for Defense Analysis, during the Cold War, breaking Soviet codes. Now, that's something like Sherlock Holmes. But he was fired from his job.
What? Why?
Because during that period, Vietnam War was going on. And despite him working for the Department of Defense, he publicly criticized America's involvement in Vietnam War. So, he was fired. Well, that was expected. It can be a good life lesson also, so don't do this, guys, if you want to keep your job. But he was intelligent, so he could get any job easily. So, he got a new job as the head of the mathematics department in Stony Brook University. In those days, Stony Brook was not as famous as now. So he did a fine job making it a good department. And he continued to do his research in maths and was awarded Oswald Veblen Prize in 1976. And it's a very big deal in maths. It's like getting Nobel Prize, but for maths. By now, he had achieved so much in his life, but there is still one thing he always craved, and that was more money. He had realized that money is power, and the only way to make money is to do business or own share in some business. So, during his college itself, Jim with his South American friends started a factory to produce floor tiles and PVC pipes, and he invested his own money to this business, which later became profitable too. In 1978, at the age of 40, he quit academia and went on to start his own trading firm called Monometrics, which he later renamed to Renaissance Technologies, or Rentech in short. People in academia typically prioritize respect and the quality of their work over financial gain. So, it came as a surprise to many when he chose to leave at the peak of his career, despite being highly regarded for his exceptional contributions to mathematics. Then, why did he left a very good career? Did he had a midlife crisis? Well, sort of. So, basically, he was working on some research topic, but it wasn't going anywhere for 2 years. No progress, nothing at all. So he was frustrated, and also at the same time, he was going through divorce. Damn. And also his old business, which I told you about, got acquired.
Yes! 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 Yes!
So, now he had some money at hand, and he invested them and found out that it was interesting, and so he decided to try a new career altogether for a change. There's a saying, right? I don't know who said it, but it goes like this. Once a man smells money, he gets addicted to it. So, same thing happened to Jim Simons. He was hooked to the game of making money by trading. So, it's 1988, and Jim starts his trading firm. As he was a mathematician, Jim wanted to make models to predict asset price movements. He knew the importance of modeling from his code-breaking days at the NSA. So he convinced his old friend from the NSA, Leonard Ebaum, to join his firm.
Morgan Stanley building, fast. Did you hear? Mortgage defaults have gone through the roof. Is anybody jumping off the buildings yet?
Why would they? Subprime mortgage bond prices are up.
What the hell is going on? We don't know.
Well, not that Baum. Leonard Ebaum was one of the top mathematical model makers at that time. But Baum started reading news articles and started having opinions about which asset will go up and which will go down. They were mostly trading commodities and currencies at that time, and Baum got less and less interested in models and more interested in fundamental trading with his own opinions. And surprisingly, they were successful too. In the first 2 years, they didn't have any models. They just traded with fundamental analysis, and they even multiplied their money by a factor of 12, which is phenomenal. But Jim felt it was hard to do this every day, as someday you would feel like a genius when you are right, and someday you will feel stupid as nothing will go your way. So Jim Simons finally decided to work on a model. So he brought in another famous mathematician, Jim Ax, and from there onwards, rest is history. Now, let's explore the trading strategies employed by Jim Simons and his team at Renaissance Technologies. While most of their methods remain confidential, I've done extensive research and uncovered some key strategies that have been publicly disclosed. At Renaissance Technologies, they didn't initially trade stocks. Instead, they focused on commodities and currencies. Why? Because commodities and currencies had some sort of underlying pattern, which could be used to make money. For example, the price of a commodity like oil tends to fluctuate around its average, a concept known as the mean reversion strategy. They would buy the asset when its price fell below the average and sell it when it rose above the mean. This strategy was highly effective in the 1980s, as few were utilizing it. However, as more market players caught on, they needed to develop more advanced strategies. Let's first understand the Markov model, one of the key trading strategies used by Renaissance Technologies. The Markov model is a mathematical framework that predicts future states of a process based solely on its current state. In trading, since the exact states aren't always known, they utilized hidden Markov models, which analyze past data to infer hidden states and make predictions about future trends. And I'm not exaggerating. If you check the Wikipedia page for hidden Markov models, you'll see the Baum-Welch algorithm mentioned in the very first paragraph. This algorithm used to estimate the parameters of a hidden Markov model was developed by Leonard E. Baum, who worked alongside Jim Simons at Rentech. Clearly, Jim Simons had some brilliant minds on his team. For better strategy, Jim needed more people. So he started hiring really smart people, people holding PhDs in science and mathematics, people who were extremely smart and did real work. His hiring strategy was completely different from other trading firms. He didn't hire people who already had very good knowledge in finance. Instead, he hired really smart people that didn't have any knowledge of finance at all. Why? Because he learned it when he was working for the NSA, that extremely smart people can learn anything fast and implement it. And at the end, that's what really matters, right? And one thing that I think is very common among successful people is that they know how to treat their employees. And Jim was very good at treating his employees. He would often call his employees for parties in his personal yacht. And the most interesting thing is that he made everyone in his firm partners. That means when the firm makes profit, everyone in the firm make profit as well. This created a fantastic work environment at Rentech, where people worked for the benefit of the whole team. It didn't matter who outperformed whom because, in the end, everyone gained from each other's success. This was the brilliant move made by Jim Simons, and it really paid off. With all these smart people, they thought of doing something that no one in the industry thought of. They were trying to build an AI model. Yes! AI models in the 1980s? I think they were too ahead of their times. Currently, we see AI everywhere.
AI first, generative AI. Third, AI, deploying AI. Finally, rigorously tested AI.
From Google to Microsoft to OpenAI to Elon Musk, everyone is talking about AI now. But in the 1980s, it was not heard that people were using AI and machine learning to do trade. But Jim Simons was one of the rarest of people who thought of this idea of using AI for trading. So, as they were the first to do this, they needed data. And I mean it, data in a very, very large quantity. And I am not kidding, they even had to go to the Federal Reserve to get the interest rate data, since that data was not available digitally during that time.
To build the original models, we needed to collect a lot of data by hand, which we did. And
they used all types of data, like weather reports, monthly earning reports, historical data, and many more. At Renaissance Technologies, they used terabytes of data a day. Remember I mentioned before that they initially traded commodities and currencies? The reason was that these markets had hidden patterns and trends that could be exploited for profit. Since all the obvious patterns were already being used by others, they sought out those less visible to the naked eye. To uncover these, they applied advanced AI and machine learning models, like nonlinear kernel regression models, to analyze historical data and predict future trends. This was their core strategy, using models to identify micro-trends and market inefficiencies in the data to predict what to buy or sell. Jim Simons didn't execute trades directly based on these model predictions. Instead, they first tested the models against historical data before applying them in real-life trades. However, this approach had its major flaws. As their capital grew, they needed to develop a strategy to manage risk effectively. The first rule of investing is to protect your capital, so they had to find a way to mitigate risk. For this, They adopted an excellent approach. They began focusing on short-term trades, quickly entering and exiting positions to minimize exposure and reduce risk. By doing this, they were successful about 50.75% of the time, just 0.75% above even odds, which seems almost unbelievable. With all their data analysis and complex strategies, they achieved only a small edge. But let me explain why this small percentage is a big deal. In mathematics, there's something called the law of large numbers, which states that over a large number of trials, probabilities will even out. It's similar to how casinos operate. It doesn't matter if a player wins more in the short term. Over time, the house always wins because the odds will revert to their true value. To simplify, imagine flipping a coin. And for flipping coin, we have a very special guest in this video.
Now, say my name. Heisenberg. You're goddamn right.
So if you take a coin and you flipped it 1,000 times, you might still get 60% heads. But if you flipped it 5,000 times, the probability gets closer to 50%. The sample has to be large enough to take luck out of the equation.
That's the law of large numbers. So there's 0.75% advantage when applied across millions of trades, created a massive difference in the long run. In the beginning, they had limited capital. So to maximize returns, they had to use leverage. But as you know, while leverage can amplify gains, it can also cause significant losses if things go wrong. To manage this, they started using the Kelly criterion, a mathematical strategy often used in gambling. It suggests that your bet should be proportional to your confidence in the outcome. They applied this concept to their leverage strategy, using more leverage when they were confident and less when they weren't. By following this method, they were able to significantly boost their profits. The Medallion Fund is, without a doubt, the most successful fund in history. However, it faced a significant challenge, which led Renaissance Technologies to close the fund to outside investors. What was the issue? In any market, prices are constantly negotiated based on supply and demand. If demand rises, prices go up, and if demand falls, prices drop. With such a large capital base, Medallion's trades started to influence the market itself. For example, when placing a large buy order, the demand surge would drive up the price, which affected the accuracy of their predictions. As their trades began to move the market, the models became less effective when dealing with large volumes. To counter this, they had to limit the fund's size and eventually found the optimal balance at around $10 billion. As a result, in 1993, the legendary Medallion Fund was closed to outside investors. Only employees at Renaissance Technologies could invest in it. Lucky them. Since its inception in 1988, Medallion has generated over $100 billion in trading profits. This equates to an astonishing 66.1% average gross annual return, or a 39.1% net return from 1988 to 2018. Sadly, this remarkable fund is no longer open to public investors, but that's the way it goes. He developed similar models for the equity markets, but so far, they haven't performed as well as the Medallion Fund. I think I know why. The commodities and currencies they originally traded had hidden patterns, making them more predictable. In contrast, the stock market is much more complex, with prices heavily influenced by factors like news, earnings reports, and many other variables. However, I believe that with enough data and more advanced models, it's still possible to find success in the equity market. While researching Jim Simons and his renowned Medallion Fund, a major question crossed my mind. If the Medallion Fund is consistently making money, who is on the losing side? Is it people investing in index funds or someone else? I have a guess. You've probably heard the saying, 90% of traders lose money in the stock market. I always wondered who makes up the 10% that actually profits from trading. I believe the Medallion Fund is part of that elite group, making its profits from inexperienced retail traders, who, more often than not, gamble under the guise of skill and end up losing money. Jim Simons didn't just stop at making billions. He used his extraordinary wealth to impact the world in profound ways. From donating generously to education and scientific research to lobbying Congress for causes he believed in, he lived a life driven by purpose. In 2024, Jim Simons passed away, leaving behind not just a legacy of wealth, but one of intellectual curiosity and fulfillment. At the end of it all, he was satisfied with the life he lived. And isn't that what truly matters?
I did a lot of math, I made a lot of money, and I gave almost all of it away. That's the story of my life. Now, it's a good story, but it's short.
Now, let's connect this to a larger question. The efficient market hypothesis. It states that markets reflect all available information, making it impossible to consistently outperform them. But is that entirely true? Let's understand it through a Veritasium video.
Randomness is a hallmark of an efficient market. By efficient, economists typically mean that you can't make money by trading.
The idea that you shouldn't be able to buy an asset and sell it immediately for a profit is known as the efficient market hypothesis.
The more people try to make money by predicting the stock market and then trading on those predictions, the less predictable those prices are. If you and I could predict the stock market tomorrow, then we would do it. We would start trading today on stocks that we thought were going to go up tomorrow. Well, if we did that, then instead of going up tomorrow, they would go up now as we bought more and more of the stock. So the very act of predicting actually affects the quality of the future outcomes. And so in a totally efficient market, the prices tomorrow can't possibly have any predictive power. If they did, we would have taken advantage of it today.
But there is a very special case. It's regarding a special financial instrument called the options. So earlier pricing an option correctly was a very difficult task.
Given the option to buy or sell something in the future, it seems like a very amorphous kind of a trade. And so coming up with prices for these rather strange objects has been a challenge that's plagued a number of economists and business people for centuries.
But a mathematician named Edward Thorpe found out a way to price the options correctly.
I actually figured out what this model was back in the middle of 1967. And I decided that I would just use it for myself, and then later I kept it quiet for my own investors. The idea was to basically make a lot of money out of it for everybody.
His strategy was, if the option was going cheap, according to his model, buy it. If it was overvalued, short sell it, that is, bet against it. And that way, more often than not, he would end up on the winning side of the trade. This lasted until 1973. In that year, Fisher Black and Myron Scholes came up with an equation that changed the industry. Robert Merton independently published his own version, which was based on the mathematics of stochastic calculus, so he is also credited.
I thought I'd have the field to myself, but unfortunately, Fisher Black and Myron Scholes published the idea, and they did a better job of the model than I did because they had very tight mathematics behind their derivation.
Within just a couple of years, the Black-Scholes formula was adopted as the benchmark for Wall Street for trading options. The exchange-traded options market has exploded, and it's now a multi-trillion-dollar industry.
Jim Simons and Ed Thorpe showed us that markets aren't perfect, and this is where hope lies. If Jim Simons could find hidden ways to make money, so can we. It's all about looking closer, learning, and innovating. And if you by chance found any market inefficiency, then please don't announce it to public. You can just share it with me. My contacts are in description.